Thank you so much, everybody, for joining us today for this webinar on tax liens and tax deeds. I will be taking you through the process of making that investment through a self-directed IRA along with my associate, Alex Burney. How are you doing today, Alex?
Another day in paradise.
If you guys have any questions, just make sure to type your questions into the chat box. We have everybody muted just to keep the webinar nice and clear. So if you have questions, go ahead and put them in the chat box, and we will answer your questions as we go. My name is Larissa Green. I've been with Advanta IRA for almost 7 years now, and I've been doing education and marketing for about 5 of those 7 years. Alex has been with the company almost just as long. Alex, has it been 6 years now?
Yeah, in about 2 weeks it'll cross the 6-year threshold. I started out, doing investments for clients for about my first almost 4 years here. So actually doing the hands-on approach of processing investments, helping guide clients as to which structures work best, closing real estate and things like that. We pulled the numbers the other day. I've closed roughly 1,200 different unique transactions for clients. That includes everything from real estate closings to tax deeds. So if you have questions, fire them off. We'll certainly happy to get them answered for you.
We have 2 offices, but we can help anybody anywhere. As a matter of fact, we even have clients worldwide, and our clients are invested worldwide. Our 2 locations are here in Largo in the Tampa Bay area of Florida, and then we also have an office in Atlanta, Georgia. The Largo office actually does handle all of the back office work for both offices or both locations. And like I said, we do have clients nationwide and even worldwide. We try to make our learning center, our education, very easy to access, and we try to keep it updated all the time. So having guests like our guests in the, hopefully sometime in the near future, Nancy Dickman, and some of the local investors that can help answer your questions on different strategies, as well as different professionals like CPAs and attorneys, join us frequently on webinars and at our locations in order to go over different investment strategies and make sure that we're assisting you guys in understanding how self-directed IRAs work and all the different investments that you have access to with a self-directed IRA. And you can access our events at advantaira.com/events. You can also check us out on demand or on YouTube with all of our archived webinars. And we also have a blog that we keep up to date on different topics that concern your self-directed IRA and the market as well. So definitely check those out on our website. Today we're going to go over the different types of accounts that you can self-direct, whether you're using a checkbook or you are directly investing through the self-directed IRA. We're also going to go over the strategies for investing in tax liens and tax deeds, and we'll let you know how our clients are doing it and maybe the most efficient way to make those investments. And then also the advantages and disadvantages of using checkbook control, whether you're investing in tax liens and tax deeds or other types of real estate investments and beyond. Many people haven't heard about self-directed IRAs just very simply because there's not a whole lot of administrators out there that can handle these types of investments. Charles Schwab, Morgan Stanley, Fidelity, they're all great companies, but they've made it a business decision not to hold what they consider hard-to-value private investments. And on the opposite end of that spectrum, we've made it a business decision not to hold anything publicly traded. So we can help you with any private investment from holding tangible real estate in your IRA all the way to gold and silver bars, but anything in the market you would want to talk to your brokerage firm about. But it is not an all-or-nothing strategy. You can self-direct a portion of your IRA and really diversify those investments. Self-direction really is talking about, on one end of it, it's definitely private investment. So holding real estate where you're collecting rent or lending money and receiving mortgage payments, and whether they're amortized or interest only. Like I said, precious metals, foreign currency, really the sky's the limit for self-directed IRAs. It's completely up to you. And it is also, just as it sounds, something that you're going to basically control. Let us know what it is that you want to invest in, find the investment, and let us know what that strategy is. And there's so many different strategies even for one type of investment. So if you want to buy real estate, as we'll be talking about today, you can do that as a tax deed option, or you can hold the tax lien, or you can hold, just go out and buy rental real estate, or you can do rehab. So the strategy is completely up to you, and you're going to bring that investment to us and direct us as to how you want to hold that investment. Many times we get the question, well, what if I don't have a Roth IRA? Can I still self-direct it? And the answer is yes. Anything that ends in IRA can be self-directed. There are some employers' plans that can be included in self-directing plans. And then we have a few others up here too, health savings account and education savings account. The rules for self-directing those types of investments, those types of accounts are the same, and so we can help you with those as well. And just to touch a little bit further on the different types of IRA accounts, traditional and Roth are the most common types of accounts that we see. Traditional, I think maybe because a lot of times people are rolling from an old employer's plan. You can move your account from an old employer's plan, whether it be a 401k, a 403b, 457, Florida drop plan, pension plans. Any of those can be self-directed simply by rolling them into a traditional IRA. If you're still currently employed with someone, you want to check with the administrator to see if they will allow what's called an in-service rollover. But it goes into a traditional IRA without any penalties, without any taxes being paid, because it's simply going from one pre-tax account to another. And then we also have the employer-based plans up here, simple IRAs, SEP IRAs, and of course individual Ks, and all of those types of accounts can be self-directed as well. And so you have a lot of opportunities there if you're a sole proprietor or an independent business owner in order to make contributions that are larger, basically covering both the employer and the employee contributions for those types of accounts. And if you're wondering which type of account is best for you, it's always best to check with a CPA on that and find out which way is best for you to really maximize your contributions. Alex, do you want to go over the types of certificates and deeds?
Absolutely. So in this realm, there are a few different ways to look at this. People kind of interchangeably will say, oh, I like to buy a tax deed, when maybe they're referring to a tax certificate, or vice versa, saying they'd like to buy a tax certificate when what they're really looking for is a tax deed. Now, what are the differences? Where do you get them? All very good questions. So what you first need to do is look up to see which county you are looking to invest in, whether that be your personal county that you live in, whether that be one near you or maybe one clear across the country. Figure out what they sell and when they sell it, because the key parts of this are that these are not just something that you can walk into like a 7-Eleven and say, hi, Mr. Taxman, I'd like to buy a tax deed. They do have particular times that they sell these. Sometimes they do them at auction. Sometimes they do it as an over-the-counter sale at a specified interest rate. So you do need to check for your particular county to see when these things are sold. And they might sell different ones at different times. Just because they have a backlog of tax certificates to sell does not mean that they are going to inherently be selling deeds at the same time, although some may very well do that. Now, what is a tax certificate? So at a certain specified time in a given county, a county will elect to get rid of their backlog of tax bills to help bring in income to people, to make sure that they are not, essentially just carrying debt. So what they will do is they will say, hey, we're going to have an auction, and everything that is outstanding after a certain amount of time that we have placed a lien on the property, we are going to sell the right of collection to an individual investor. Now, this can be really attractive because typically they will assess the ballpark number for a lot of them is going to be about 18% starting point for a tax certificate of penalty that the individual that owns the property has to pay in order to clear the lien off of that property. So essentially you are buying an outstanding bill that in turn the person, by virtue of the fact that they would not like to have their property sold with the deed on, have a tax deed sold on it, will inherently pay. So the person makes the payments to the county, and then you receive checks from the county, whether it be on a quarterly, annual, or if they pay it off in a lump sum basis to remove that lien from their property. Now, keep in mind that the tax certificate comes with zero interest in the real property. Just because you purchase the actual right to collection does not mean that you actually have anything that would allow you to, per se, record it in the public record saying, I now, John Smith, own this piece of real estate. Now, the nice thing with tax certificates is that they're pretty cheap for the most part. You're not going to be buying tax certificates for tens of thousands of dollars for the most part, depending on the county, how big the property is, how much the tax bill was. These things can certainly scale relatively infinitely from any price point to another. So understanding that that's kind of the good intro to look at is good. Now, the tax deed, by virtue of the fact that it has the word deed in it, kind of is a clue that this is going to actually be an interest in real property. Now, when you go to purchase a tax deed, this property has been in delinquents of taxes for some time. They have made non-payment, and now the county is going to issue the title to the property to the buyer that is going to satisfy at least satisfy their basis of debt that they have put out there. So if a tax bill was $10,000, they're going to sell it for $10,000 and up. Now, these deeds are typically going to almost always be sold at auction. Very rarely are you going to see these being sold in an over-the-counter manner. And when I say over-the-counter manner, it literally is you go into your tax assessor's office in some counties, you can just go up to the clerk's desk and say, hey, give me a list of currently outstanding tax certificates and buy them. Most of the time, deeds are not sold as such. They are always sold at auction. Now, when you buy the deed, you have the right to record that. However, you do have to be wary of any and all other encumbrances that are going to be out there. So if there is an IRS lien, a federal tax lien, if there is a mortgagor out there that has a recorded lien against the property, all these things go into what it's going to take to quiet that title. Now, sometimes you might get very lucky and inherently have zero issues with the title, but you might have a lot of issues with it. So buying the deed can come with a little bit more of an inherent risk, but once you do quiet that title, depending on what the underlying value of the property is, you might actually make a very substantial amount of money. One example I use a lot from my time when I was actually doing investments for clients is that the largest single return on investment from the amount of basis the person invested to the amount they ultimately got paid out was actually on a tax deed. He was in a suburb of Atlanta, and he had a traditional IRA that we were going to bid on tax deeds with. He ended up purchasing a tax deed in one of these suburbs for roughly, if memory serves me correctly, it was about $120,000 that he bought the tax deed for. After about another $30,000 worth of legal work, and he had to pay all of that out of his IRA, so about $150,000 of investment into this. He got all liens quieted. He got a full warranty deed issued for the property to the IRA. He ended up selling the property for over $1 million. So all of that going directly back into his IRA, not having to pay any type of short or long-term capital gains, not having to pay any ordinary income. He got a wire at closing for over $1 million to his IRA and had no tax bill due at that time. So it really kind of goes to show that you can really hit a large, that certainly would be a home run. It's not typical and it's not a guaranteed type of return on investment, but the potential is there for these kind of things to happen. And understanding the differences between what a tax certificate is and is not, and what a deed is and is not, will really help kind of guide you through this process and help you better understand which one might be a better fit for you.
And I do want to point out, it's very important that if you're thinking about making these types of investments, that you find out more about the state and county that you're thinking about making purchases through, as Alex pointed out, because you do want to keep in mind that the laws are going to be different everywhere. So just to kind of compare and contrast, here in the state of Florida, tax liens or tax certificates are a separate purchase than a tax deed. And if you own a tax certificate and it is not paid off, that does not entitle you to the deed. What it does is have you give you the opportunity to force it to auction, to the deed auction, but you will be bidding on it just like everybody else. It doesn't give you any more ability to own that deed than anybody else that might be participating in the auction. Whereas I know in the state of Georgia, if you buy the certificate or lien, or it's my understanding anyway, that if you buy the certificate or lien and it does go unpaid, that entitles you to the deed. So very important differences there. Depending on the state and county that you're working with, there's going to be differences. So you do want to make sure that you're looking into that when you're deciding where you're going to make your investment.
I got a couple of questions that rolled in there. Paula asked, what if there is a person living on the property? Well, if you purchase the tax certificate, you've purchased a back tax bill. They are still going to be a tenant in the property if there was an outstanding lien. You have no ownership of that, so there still could be an enforceable lease with the current owner of record of that property, and they would still be making payments outside of that. You are only going to be getting payments from the county in that regard. So really nothing to do with the person living there. Now, let's say you have a tax deed, a recorded tax deed. Now, at that point, you do have you have a potential for titled ownership of the property. Remember, it has to go through the full sale and you do have to have it recorded. Now, before you can potentially sell it, you do have to quiet the title. But at that point that you own the tax deed, you're going to be the owner of record of that property. So dealing with a tenant, any type of old lease, you're going to need to get a real estate attorney involved or other type of outside counsel, because you might have grounds for eviction. You might be able to sign a new lease with that person if you were looking for an income type of property. So the options are varied, but keep in mind, you really don't need to worry about whom is living in the property until you get to the tax deed level, because remember, the certificate, zero interest in the actual ownership of that piece of property. Casey asked, after a real estate investment is completed, is your account earning anything, or does it just sit idle in your self-directed IRA until you purchase your next lien? Well, the inherent nature of a tax lien is not necessarily something sitting idle. It is going to typically be an income-producing investment. Now, earning anything, the 18% return or the 18% penalty that is going to be assessed by the county, and again, that can scale. Sometimes it's in different areas. We'll scale down, scale up from there. That would be your return on investment. It is not necessarily just something that sits idle. Do we offer any directed investments? No, but that allows you as the client to have a zero conflict of interest with us as your custodian to go out and purchase different things that you see fit, whether that be tax certificates, real estate, mortgages. So essentially, it's the investment that you choose is going to be what is going to actually be producing the income that your IRA realizes, and ultimately, again, remember, not paying any taxes on that. So thanks for the questions. One more before I hand it back over to Larissa. If you buy a tax deed that has a mortgage lien, do you have to pay off the mortgage to quiet the title? It depends. So what I'd say is that when you're doing this kind of stuff, having a good title agent or a good basis of knowledge, or just, not necessarily having any qualms about picking up a phone call and calling someone is good. Do you have to pay off the entire mortgage? Potentially not. You can work something out with the mortgage lender, and depending on who they are and how long it has been since they have been paid, you might have a significant amount of leverage in order to get them to take a reduced payoff, or depending on what the underlying value of the property is and what you could potentially sell it for, work out an agreement to where they get paid out of closing and still make a considerable spread on your investment, even with having to pay off a mortgage that is out there as well. And can you obtain title insurance if it's a tax deed? You would have to go through a title search, and they would have to underwrite it. Essentially, at that point, they would be issuing a full warranted deed. So the answer is yes, but you would have to quiet the title and get any and all other positions off of the public record before you could actually get title insurance on that. Larissa?
So quickly, what we're going to do is basically give you an idea of the differences between making these investments directly through the IRA, going through Advanta to assist you in making those investments, and with Advanta holding the checkbook basically, and then also with our clients using the checkbook control strategy. And I'll give you an example of that, and then Alex will go over checkbook control with you with a self-directed IRA. So when you invest directly through the IRA, you're going to reach out to Advanta, and the deed or certificate is in the name of the IRA. So Advanta IRA Services, LLC, for benefit of your name and your account number, and that goes directly on the deed or on the certificate as owner. You would work with your Advanta IRA specialist in order to deposit funds with the county or the auction house for auction, work with Advanta IRA for the final payment, and then each county is different, and it may be difficult to make payment deadlines if they will not accept a wire. So these are all really important points. And again, because it's self-directed, it is the responsibility of the account holder to look into the counties that they're going to be working with or the auction house they're going to be working with. And then once they make those determinations and they come to us and say, hey, okay, they require a 5% deposit, let's say, for example, they'll be setting up whatever it is that they need to set up with the county in order to have rights to bid on auction day. We'll help them make that deposit, and then they will have to, the client will also have to figure out when final payment is due and get on the phone with us immediately after being awarded any liens or deeds so that we can make sure we can make the final payment deadline. That's very important. When you're using checkbook control, deeds and certificates are in the name of the LLC or trust. So instead of it being Advanta IRA for benefit of your IRA account, it will be, if you name your LLC Sunshine LLC, it will be Sunshine LLC on the deed or certificate as owner. And then you as the manager are going to direct those purchases. So you're going to have a bank account and direct funds to the county, and on the day of final payment, it'll be your responsibility to complete that purchase. What's very important about having checkbook control is that the manager of that LLC or the IRA holder, who is typically the manager in this case, will be responsible for all of the record keeping, and we'll kind of go over the examples of that with you. So our first case study is directly through the IRA, and in my example, Susan purchases tax liens using an old 401k. So remember at the beginning I said that you could use a 401k to roll it into a traditional IRA and make self-directed investments. So in this example, she has $10,000, and the great thing, as Alex mentioned earlier, is that with tax liens, you can potentially start with even just $1,000. So it's a great investment for smaller balance accounts. In this case, she decides that she's going to purchase tax liens in Pinellas County, Florida. She'll do all of her research on the liens that she'd like to purchase. So that's important, guys. Remember that Advanta doesn't give you investment advice. So Susan is going to make those inquiries on the liens that are listed for sale, and you can do that ahead of time. I know, for example, with Pinellas County, they put out a list of what's going to be available on the auction day quite a bit ahead of time, and you'll be able to look at those and do research on the ones that you would like to bid on. And, you know, I've heard people doing research on 100 because you just don't know if you'll even be awarded one depending on how the bidding is going. And as Alex mentioned also, you know, certain times of year, you know, they might put stuff up for auction. It's not all the time. So I know for us here in Pinellas County, it's the end of May. I think Hillsborough and Pasco are similar, May and June. And so it's just that one time of year that you can bid on tax liens, and so you have plenty of opportunity to do your research on those liens that you want to purchase, as well as any tax deeds for auction. And I think deeds are much more often, the auction is much more often, but you would have to look into it for your county. So after doing research, Susan contacts the county to find out what the bidding process is and finds out she has to put a 5% deposit with the county and do a username and password for their bidding site, and she'll go ahead and do that. Her responsibility will be identifying the county and certificates and letting us know what it is that we need to work with the county on and how much we need to move over on her behalf. So we'll have her complete a purchase authorization form letting us know, and it's very similar to doing earnest money with real estate. We'll have her fill out our form letting us know, I'm going to do tax liens with Pinellas County. Please send money to via wire or cashier's check or however the county prefers to be paid. We'll send those funds over, and then once the auction is over and Susan's awarded tax liens, she's going to get back in touch with us so that we are aware of the amount we need to send and when the deadline to send those funds are going to be. After the purchase, as the certificates are paid, the county sends the payments to the IRA directly. So Advanta IRA receives payments on those liens, and we will deposit them to her account. Susan will be responsible for keeping track of which certificates are paid, and then once she has been paid by all the certificates in her account, she'll let us know, and we'll close out that county for her account at that time. Problems that might arise for Susan making this investment directly through the IRA: some counties will not accept a wire for deposit or final payment. They will only want a cashier's check, and so us ordering a cashier's check and having it here within 24 hours many times is not a problem. If it's the same day, we might be a little slower on something like that. Final payment due within 24 hours, you know, if we don't have a final payment amount, if we're waiting on paperwork, that can slow things down. So that's something you definitely want to take into consideration when you're making these investments and finding out what the process is from each county so that we can be sure to help you with that process as quickly and efficiently as possible. Fees to Advanta are paid per county. So if you're investing in more than one county, if you're going to invest in our area, for example, Pinellas, Pasco, and Hillsborough County tax liens, you're going to be charged per county. Each county is considered an asset with us, and so you're going to pay higher fees. And each county, because of their different system, may not work with the IRA directly. So those are some sort of bumps in the road that you may have to overcome. And so we're going to talk next. I'm going to turn it over to Alex to talk to you about checkbook control and how that might make the process a little more efficient for you. Alex?
Yeah, thank you. I have a few questions. Just going to clear those off before we dive into that topic. Sue Ellen asks, as a manager of a self-directed IRA, checkbook is allowed to make decisions on investments and approve renovations, but not do work on the project, correct? If you do actually end up getting a piece of property out of this, or if your ultimate goal is to invest in real estate with an IRA, you can essentially coordinate Everything with the IRA-owned LLC, you can qualify your tenants, you can inspect the work, you can make sure everything is done to your liking, but essentially the line is going to be drawn at swinging a hammer and rolling a paintbrush. When it actually comes to putting on putting in work to the property, that is where the line is going to be drawn. Jerry asked, if I have a checkbook control of the funds, why does Advanta need to make the deposit with the county? If there was any confusion on that, they don't necessarily, that's not how it works. If we are doing it directly through the IRA, then we do have to make the deposit at the county. If you are utilizing checkbook control, essentially we are mainly only concerned with the LLC. We would be making the initial deposit and any subsequent contributions to the LLC's bank account as a capital contribution. We would not be making the deposit directly to county. You would actually be doing that as the manager of the LLC. So that's how that would work. So thank you very much for the questions. So we like to throw around the term checkbook control, IRA-owned LLC, a bunch of different terms kind of referring to roughly the same thing. Now, what is a checkbook control IRA? It is where you as the client have elected to set your IRA up to where that you have much tighter control of the funds and the bank account. The most common way that we see is that a client will elect to establish a newly formed single-member LLC that the IRA will be named as the 100% member of, so it would be the sole shareholder, and then we issue the funding directly to that LLC bank account with the IRA owner named as the manager. So that's where essentially you have the term checkbook control coming from, is that the IRA owner at that point will be issued a checkbook for the LLC that you have established in order to move the funds into that. Now, understanding what exactly goes into an LLC is important in this, because obviously not everyone has gone through the procedure of doing an LLC. Even if you have, you might not have done one to the point that we require. So just to establish an LLC in any given state, you typically do not need an operating agreement. Now, an operating agreement is going to be secondary from just going to a particular state, paying your registration fees, and now you have an LLC registered. An operating agreement is going to detail the relationship between the owners of the company, management of the company, and the limits of liability that are extended or not extended for actions going on in that entity. Now, the key things for an IRA-owned LLC, you don't need to kind of have a degree in law to really understand this and understand it very well. So you're going to have an owner, a shareholder. That is going to be the IRA in this case. The IRA is going to be the sole owner of the LLC, which is what's going to allow Advanta to take the money out of your IRA and issue it to the LLC. Essentially, think about it like this. You are buying a brand new LLC in your IRA. That's the way that we're looking at it. When you look at your account statement, you will see Sunshine LLC as the sole investment of your IRA. Now, the actions of this LLC need to be managed. Just like you would see someone coordinating the acts of employees at McDonald's or Walmart, you need to have a manager. So in this case, typically the client is going to be named as the manager. They're going to be making decisions, to be signing checks, contracts, making all of the ultimate investment coordinations that go along with this type of setup. And then again, the operating agreement is what's going to detail all of this and actually create the ecosystem, essentially, for the interaction of your IRA to this new entity. Now, I said that the LLC is the most common way that people like to do this. It's not the only way to accomplish it. Some people elect to utilize a trust, and in this case, okay, we have a question. I'll get to that in a moment. So you can also have a trust. It has to be a grantor beneficiary trust. What does that mean? It means that the person adding the money in this case the IRA, is going to be the person that is going to be the individual receiving the sole benefit from it. So just as the member of an LLC is going to be the owner and ultimately the one that gets all of the benefit from that investment, in a grantor beneficiary trust, it operates the same way. The IRA is named as the person that's going to be adding the capital, in this case cash, to the trust, and then when there's any ultimate benefit, so profits or just distributions back to the IRA, they're going to be the sole beneficiary of those benefits as well. The main difference in this is that it's a little bit more arm's length than an LLC, because you do have to have a third party acting as trustee of the trust. But other than that, it operates almost analogous with the LLC. There really isn't any huge difference in the types of investment, how you invest, or really anything else structurally between using the two. Ultimately, it just kind of boils down to a personal preference and how you'd like to have things run as well. Okay, Sue Ellen asks also, as manager, if beneficiary or owner cannot keep the books for the LLC or provide services, you do need to do all of the accounting and record keeping for that LLC. Now, when you're talking about services, if you're referring to paying a bookkeeper or something that someone would have to be paid for, then yes, that's not something that you could do. But simply keeping records and maintaining receipts and keeping the books, if you will, of the IRA-owned LLC, that's not inherently an issue for you to do yourself. If you do need to pay someone to keep the books, then yes, it would need to be an arm's-length third party, such as, John the CPA or Jane the accountant. You would need to go and find a third party to do that if it's something that you do need to pay a third party for. Now, most people like to understand a little bit about the legalities behind this because it certainly is a little bit more of a niche type of investment and not something that if you go to your local bank or investment advisor, they're going to be like, yes, the IRA-owned LLC. It is definitely a smaller demographic of people that use this, but there is specific case law that does look at exactly how these structures are kept. Now, keep in mind that we always, at the end of this, will have to disclaim that when it comes to making the ultimate decision for you, you have to get professional advice because they are going to know exactly what you are doing and exactly how this operates, because these case laws, they don't always necessarily examine every part of what may be an issue. Now, the first one that kind of establishes the ability to have a checkbook control IRA-owned LLC is a case from 1996 called Swanson v. Commissioner. In this case, Swanson had established a new entity for the purpose a new entity that his IRA purchased 100% of the shares of. Now, it was going to be buying and selling accounts receivable. He owned a shipping company personally as well. Now, he was named as the manager. He was operating everything, got audited, and the IRS tried to deem it that it was a disqualified transaction because he had sold personally owned shares of a new company to his IRA. So essentially, he had conveyed or sold a personally owned asset to his IRA, which is a disqualified transaction. So in the examination of this, that's the specifics that they looked at, was the conveyance of that membership to the IRA. Well, since it was a newly formed entity, there was no previous ownership of it, it had not been funded to any type of capital account, they deemed that it did not qualify the IRA on that grounds, because if no one owned it previously, if it was brand new, then he could not have sold it to his IRA. So he won the case. He actually turned around and sued the IRS for legal fees and won, which in my opinion kind of paints a bigger target on your back than need be, but he did. But it didn't examine everything. It didn't kind of answer all the questions. He did end up, it came to light that he was paying himself, and he was also purchasing his accounts receivable from his personal company as well. So there's kind of a lot of things that weren't examined, but the essential basic structure of having an IRA-owned LLC is kind of blossomed from this one case. Now, there have been some more cases that have come out since then. I've examined some more items of it, but the other big one that we'd like to look at is that people really kind of like to focus on the ability of being the manager of the IRA-owned LLC. As Sue Ellen had asked earlier with regards to what role you can exactly have. Well, there was a tax court memo that was issued in 2013. An individual named Ellis was being audited and then sued by the IRS and tried to and having his IRA disqualified for what he was doing with an IRA-owned LLC. So the IRS was examining the issue of him acting as manager and the related issues around that. Now, when they issued their opinion on this, because it did go to fruition, there was no settlement with the IRS, so it became public record, is that the IRS disqualified his IRA because on the basis of him taking a salary or taking direct benefit from the IRA-owned LLC is what they found issue with and ultimately disqualified his IRA with. But specifically in that tax court memo, they did not find issue with him being named as the manager. It was only the fact that he was being paid and compensated for, acting as manager that they took issue with. So that is really kind of the basis for most of the legal aspects of this. There have been certainly some more cases that have come out since then. I think there was just one last year that kind of examined some more specific points on how these IRA and LLCs work and with regards to tax reporting. So it's coming out new every day, but the nice thing is that every single time one of these comes out, there really hasn't ever been a step back. It's always been kind of more on an affirmative track of looking at more of the specifics and giving us actually better guidance on how to do these things correctly so that ultimately if you want to do them, there is a good book of case law and a good book of information that is provided to us to help make sure that you are doing this in the best possible way going forward if you are electing to do this type of investment.
So a quick look at the pros and cons to this type of investing. So, of course, quick access to IRA funds for auctions. So that's really what we're talking about here. The ability to write the checks yourself and manage the funds, so to speak, in order to make those final payment deadlines with auctions and with the county. And so, having checkbook control will definitely make that a little bit easier for you. And, of course, as I mentioned earlier, we do charge per county. So if you're investing all in Pinellas County, all the tax liens that you purchase are in Pinellas County, you can certainly do that and pay lower fees. But if you're going to go Pinellas County, Hillsborough County, and Pasco County, those are going to be considered three separate assets for that account, and you're going to pay more fees. So you're going to be able to, through the checkbook control, pay lower fees on your Advanta IRA account. And then also possible asset protection and anonymity. If you're looking into the legalities of that, definitely talk to an attorney and find out the best way to hold your investments in your IRA. But, that's one way at least to achieve anonymity and also possible asset protection. And then, of course, the cons. Responsible for accurate record keeping. Sometimes I talk to clients who say, I do not want to have to worry about the records. I would rather you guys do it, and I'll pay you that fee, in order to keep those records. And if you had an account with us and you asked us for, every funding in and out of the account down to the penny for the last 5 years, we could print that statement for you in 1 minute. So you want to keep those types of records yourself as well so that you have accurate reporting in case the IRS should ever question, where this money went to or where this payment came from. Also, lack of oversight by the IRA administrator. Now, we don't, we do our very, very best. So we ask about your investments, but we don't question everything down to the dollar as to what it is that you're doing inside of your IRA. But when you have questions and you come to us, and we're happy to answer your questions regarding the rules. And so if you were going to, for example, lend money to your son or daughter, we would say, I'm sorry, you can't make that investment. It's against the rules. But when you have checkbook control, it's a lot easier to go ahead and make those investments that might be prohibited because you're not coming to your Advanta IRA account manager and saying, hey, I'm ready to make this investment. And so you have that lack of oversight from us when you have checkbook control. And so easier to engage in prohibited transactions and something as simple as a prohibited distribution. So writing a check from your IRA LLC directly to yourself, that's very simply a disqualified distribution. And so you want to make sure that you're following the proper process when you're making contributions, taking distributions, and making investments, even though you don't have to come to Advanta when you have checkbook control. So that's very important there. Alex, do you want to talk about how the auction process works with the counties?
Sure. So understanding how these auctions work is going to be very important. Before we really dig into that, I think Sophie has a pretty good question. Let me read through this real quick. If I make Okay, so with regard to the question, essentially it boils down to if you have a checkbook control, if you have a checkbook control function with regard to your IRA, and you are not a naturalized citizen, is kind of the boiling this down to with visa requirements. You remember, you are not working for your IRA. You are just coordinating the actions of your LLC with regard to the investments that your IRA has. So you're making qualified earned income in the United States. You can have an IRA. You can have a 401k, even if you're not a naturalized citizen, for working on a work visa or many other different types of things. So the citizenship is not really an issue with this. But remember that you are not getting paid and you're not taking any type of compensation for this. The tax court memo in 2013, TC Ellis, addressed that. So the secondary one that we went over in the legality slide, you're not taking any income from this. So you're not really going to run into that issue, at least from the purposes of the question that you asked. Okay. So understanding how auctions work. So most people understand that there is a generalized way an auction works. You have items that are going to be put on the auction block. You can bid on them. If you outbid during the bidding time, then you don't win it. If you are the highest bidder, wins the auctioneer or auction service ends the auction, you then own the item. So the basic principle is important to understand. However, with this type of investing, it is not always the same. So an interesting way that these work is depending on the county, and even where we are in Pinellas County, Florida, in the Tampa Bay area, we have kind of a reverse of that, is where the winning bidder on a tax certificate will actually be the lowest bidder to the point of the interest rate. So you're actually bidding on the amount of interest penalty that is going to be given to you. Given to you as the investor on your actual investment. So if it starts at 18 and then you bid that you are willing to accept 10%, then that spread of 8 is going to go to the county and you're going to net the other 10. However, you might have to go significantly lower depending on the amount of the underlying bill. Obviously, 10% of 1,000 is going to be much less than 10% of 10,000. So the workout is going to be there depending on how exactly it works. And then if you are the ultimate lowest bidder in our county, then you win that. Now, you're going to have a bidding account. They're not just going to let everyone sign up and then bid to a certain amount that they want to. You're going to have to typically put down between 5 to 10% of your maximum bid. So if you would like to bid up to $50,000 in one sitting and there's a 10% amount that you have to put down, you're going to need to put down $5,000 into a bidding account. And then at the end of it, you're going to be assessed the final bill with regards to how much you actually owe. Now, coming back in from what Larissa was discussing on how exactly it works to utilize checkbook control versus buying it directly in an IRA, this is where you're really going to see the differences and which one might make the difference for you. I always encourage people, look at the county to see what exactly they require. And if they require a wire the following business day, have us do it. Save yourself the money in setting up the LLC. However, with the example I gave of the individual that went to a tax deed sale, we actually spent thousands upon thousands of dollars shipping cashier's checks in various denominations to the individual so that he could attend the auction because they required cashier's checks day of. So it just kind of depends on what they require. And if they require a check day of, unfortunately, it just can be operationally infeasible for us to have a check ready for you to be handing it into someone. And especially if you're not local to us, it's just something where having a checkbook control IRA, whether it be an LLC or a trust, is really going to make your experience much better, and also let you attain your goals much easier rather than trying to do it directly through an IRA. Now, remember, it's going to be important when bidding on deeds to understand that there could be substantial legal fees associated with purchasing a tax deed. Now, purchasing a tax certificate, remember, you don't have any type of ownership invested in the property. You're just essentially buying a collection right on the property for a delinquent tax bill. But when you buy a tax deed, you are buying an interest in real property. And if there are any other additional liens or judgments or anything else that is attached to that property that wasn't simply discharged by the tax deed sale, which is typically very, very little, then you're going to have to go in and quiet all of those items. Now, it might be hard for you to sell that tax deed if it comes to light that there are a lot of title issues with it. So understanding that there is some inherent risk associated with that, if you are buying something that has not had a title search done on it yet, then it's a good place to start out from. And again, depending on where you're going to be bidding, always check with the particular county to make sure that you don't necessarily have to have an LLC or a trust in order to participate and get the ultimate investment that you're looking to have. So that's really kind of how that works. I always like kind of seeing the different ways that clients this work. In all honesty, when I did investments for years for clients, the majority of people that do this, that do tax certificates, typically utilize checkbook control. We are always happy to take it on a case-by-case basis to see if doing it in the IRA will work, and if we can, we would love to do that for our client. But if you are interested in doing this, just kind of go into it with eyes open that doing a checkbook control function might be the best way to go for you. And again, checking with your counsel, whether that's an investment advisor or an attorney before doing this, is good, especially if you have to do specific structures. But that's just one thing I like to impart to people, is understanding that a lot of counties doing it within some type of checkbook control can really make things run a lot smoother. I have a few questions that popped up. Let's get those addressed before I hand it back over to Larissa. Okay, looks like she got those. So Derek asks, how can you initially fund a self-directed IRA if not from a prior retirement plan? Good question. So you can fund it from your earned income. So if you have Schedule C earned income, if you get a W-2 at the end of the year, you can contribute some of that money into it. If you're under the age of 50 and a half, that limit's going to be $5,500. If you're over the age of 50 and a half, you can contribute up to $6,500 into that plan. Now, if you're self-employed, you could potentially set up a 401k or a SEP IRA and get much higher amounts of money into that. So depending on how you're employed, where you get your money from, how much money you have in savings, can really kind of drive what exactly you're going to be contributing into that. So we can certainly go through that. And I actually just did a webinar, I believe last Tuesday, on maximizing contributions in an IRA. So if you just go to youtube.com/Advanta IRA, my contribution maximizer webinar is right up there. And Derek, I think that'd be really good for you to look to, because it explores all the different kinds of plans and how to get money into there from a standpoint of not necessarily having an old 401k to roll it over from. All right, Suzette asks, is there any administrative requirements or reporting that has to be done with the checkbook IRA setup as compared to non-checkbook self-directed IRAs? To an extent, yes. You will need to provide us with an unaudited balance sheet of that LLC on an annual basis, so that way we can properly do our IRA to IRS reporting. If you were to hold everything here at Advanta, essentially it is face value plus cash of your account that we would be reporting if you simply just held tax certificates. So we do need to know exactly the value of the holdings of the LLC plus the cash on an annual basis. It's not, terribly hard to do that per se. It's just, like I said, an audited balance sheet, cash plus assets minus any liabilities of the IRA-owned LLC. And you only need to do that as of December 31 of every year. So you don't have to do it quarterly, annually, or weekly or anything. We just need that on an annual basis. All right. Sophie asks, if I assign the lien certificate to another investor, or flip the house acquired through tax deed to another investor, would I consider it as actively dealing and get in trouble from an immigration point of view? Very interesting question. I wish I could more accurately answer that. I would probably lean less to the more the point of no. Your IRA is a disregarded entity from personally, so it's not necessarily viewed as the same as like having a personally owned LLC. So if you personally had an LLC in your personal name and then you bought and sold property, that can be seen as an extension of yourself personally. The Supreme Court in the state of Florida actually does make that designation for a single member LLCs, that there is no liability protection extended to that, because they see them as just a pass-through entity for whatever the ultimate owner is doing. So depending on what you're doing and immigration law, I'd say that the potential is there. But from what I've seen with IRAs, I would tend to kind of gravitate towards no, but I would not really wade into giving a concrete answer to that. I would certainly have to defer you to proper legal counsel on that one. Tamara asks, can you leave your current assets Advanta control and then take a portion for checkbook control to purchase tax certificates? Absolutely. We have people that do exactly that, where let's say they bought a property or have a mortgage or lent some money out, and then they want to do tax certificates, and it necessitates using a checkbook LLC or trust. You can absolutely do that and just kind of carve out a portion of your cash for doing that and hold an LLC and other tangible assets in the IRA. It's certainly not a problem. And Rashidi asks, can the LLC created by myself for Checkbook IRA be considered a qualifying entity that would allow me to establish a SEP IRA or solo 401k? Great question, but unfortunately not. That would have to come from an entity that you establish for your personal benefit. So a service company, selling widgets or providing services that would generate W-2 earned income to yourself personally that you would be paying Social Security taxes out of. So FICA and FUTA qualifying income is what would have to be generated and received in order to have a SEP IRA or solo 401k. But I do like the creativity in that question very much. So I'm going to turn it back over to Larissa now for some more review.
Thank you, Alex. So we'll just go over one more example here of checkbook control and go over the process with you for that. And while I'm going over this last example, go ahead and make sure you get your questions typed into the chat box because we're going to be finishing up in just about 5 minutes here. And then we did have another question pop up from Patricia. Is the bidding account set up with the county or with Advanta? The county itself. So you're going to set up a bidding account with the county. It'll be something that you want to work with your Advanta representative on, but it will be set up with the county, and it's something that you're going to reach out to the county in order to get that process started. So in our example here, Gary is going to open and fund a checkbook control IRA by using an LLC. So he's going to use a single member LLC. First, he's going to open and fund his Advanta IRA account, and then Gary works with an attorney to set up the LLC and draft the operating agreement. So Alex mentioned how important it is to have the operating agreement from the IRA standpoint because that is going to show the IRA as a member or owner of that LLC. And so it's going to show the LLC as owned by Advanta IRA Services, LLC, SBO, your name, and your account number to demonstrate this entity is an investment of an IRA and therefore under the tax-sheltered umbrella. Once we have the operating agreement, we're going to review it and make sure that it has the proper wording and documentation for the IRA as owner. And then once Gary submits his purchase authorization form letting us know that he's investing into the LLC and where to send the funds, we'll go ahead and sign off on that investment after Gary reads and approves everything and fund the account. So now the LLC bank account, which has been opened by Gary, is going to be funded by Advanta IRA, and Gary is ready to start making investments. A few points on that. Gary, as manager, will set up the bank account, so that's completely up to you. The investment itself is the LLC, and from there, Gary, as a manager, is going to choose where he opens his bank account. It's not with Advanta or Advanta's bank. It's going to be with Gary's bank or the bank that he chooses to do business with through that LLC. Once he has his IRA funds in the LLC, he's going to direct the investments, and it's his responsibility to sign documents for investing and also receive income and pay any expenses that apply to that investment. So he's not coming to Advanta at all. And remember, in the pros and cons, that's where we talked about having proper record keeping so that you can make sure that funds in and out of the account are for those investments. And so what you don't want to do, for example, is front the money for an expense for the IRA and then reimburse yourself down the line. You want to make sure that you're writing checks on behalf of those investments directly from the IRA LLC bank account. Gary can determine which counties he wants to invest and then handle the details without Advanta's involvement. And then Gary has the ability then to write the checks on the spot. That would make it much easier for him to meet those county deadlines for auctions for this type of investment. And we did have a few questions come up. We had a question about a defined benefit plan. Can that be converted to a self-directed IRA? In some cases, they can be. If you're still currently employed, it's something you want to check with the administrator on. If you are no longer currently employed, where that defined benefit plan is held, reach out to us and we can go over finding out whether or not you would be able to move that to a self-directed IRA. Another question on the LLC or trust being comparable, but the trust does the trust provide greater protection and anonymity? And that's a great question for an attorney, Derek. Thanks for asking. Check in with your attorney on that. Some people prefer the LLC and some people prefer a trust. I think it just depends on what type of protection you're looking for. We had another question pop up on, does it matter which state you establish the LLC? That's another great question, and it does not. It's completely up to you We definitely have clients that tell us they prefer to form their LLCs with with Nevada or Delaware. So it's going to be completely up to you where you form that LLC, and you just want to work with your attorney or CPA to establish that LLC and then get the paperwork over to us. I had a question on the annual fee for checkbook control. The annual fee is based on the number of investments in your account ultimately. And so if you have checkbook control and the investment is directly into that LLC, the LLC can hold any number of investments that it wants to, and you're still just paying one annual fee based on the IRA holding the LLC directly. And then in turn, the LLC has any number of investments, and when Alex was talking about annual reporting, that's how we know what the value or number of investments in that LLC is, because you're going to report, so you're going to turn around and report that to us, and we'll report the value. But because we're only record keeping for the LLC itself, we're only charging one annual fee for the LLC. There was another question popped up. Can we have a copy of the presentation? We happily share this with you. We'll make sure that it goes out with a recording to the presentation. Everybody that's registered will receive a recording, and we'll make sure to send out the PDF of the slides as well. If there aren't any other questions, I think that's going to wrap it up for today. Alex?
Nope.
Okay, I think that's it. We thank you for joining us, and like we mentioned earlier, we did have Nancy Dickman scheduled with us from Pinellas County to talk about tax deeds. She was unable to make it today, so we're going to go ahead and reschedule that with her, and as soon as we have a date for that presentation, we will let you know. You guys are on our invite list, and so you will receive those updates when we have a new date for that. Thank you so much, everybody, for joining us, and we look forward to having you with us for another educational program.